Hi, I'm Evaldo Albuquerque, editor of FX Breakout Alert. In the first part of this video, I explained what is a pip, and I showed you how to read a Forex quote and how you can actually make money when currency pairs move. In the second part, I'll show you how to open a trade. But before I do that, let me share with you a few websites that may be very helpful to you if you are new to the Forex market. The first website is babypips.com. This is a website that has all the basic information on the Forex market. It has all the terms you need to learn before you actually start trading. So if you are new to the Forex market, this is a good website to visit. Once you are after you get familiar with the terms and how the Forex market works, you should open a practice account. With this kind of account, you'll be able to open trades without risking any money. It's a fake account that lets you try out the platform that the broker offers. And you should always try out several different brokers just to get a feel for the right one for you. And that's why I have listed 4 brokers that I know offer a lot of currency pairs. So these are some brokers that you should visit and download the platforms. That way you can try the platforms and choose the one that works best for you, the one that you feel most comfortable using. Now, before I show you how to open a trade, let me explain what is the lot size, because sometimes a broker will ask you what kind of account you want to open. There are basically three types of accounts: micro account, mini account, and a standard account. With a micro account, you'll trade micro lots. One micro lot controls 1,000 units of a currency. One mini lot controls 10,000 units, and one standard lot controls 100,000 units. The more units you control, the more leverage you are using, and the more money you have at risk. So you should only open a standard lot account. You should only trade standard lots if you have more than $100,000 in your trading account. If you have less than $100,000 but more than $10,000, you could trade mini lots. And if you have less than $10,000 in your trading account, you should be trading micro lots. I know this sounds confusing at first, but this will become clear once I show you how to open a trade. You will understand better why you should never trade these standard lots if you don't have a lot of money in your trading account. So let's take a look here and see how you can actually open a trade. Let me adjust the size of the screen. Okay, so we're actually looking at the platform of Oenda, and you can see here at the left you have all the currency pairs that are available that you can trade, and you have the Forex quotes. So you can see all the currency pairs, and here you can adjust the one that you want to look at the chart. So if you want to look at the Australian dollar, and you can go back to the euro, and here you can adjust the time frame if you want to look at hourly chart. So let's go back to the daily chart, and you can adjust here the type of the chart if you want to look at a line chart, or if you prefer to use a bar chart. I personally like to use the candlesticks, so let's leave it at candlesticks. And once you open a trade, you will be able to track your open trades at the top of the screen. So let's say you want to, let's take a look at the Turkish lira, just for example, if you want to open a trade in the Turkish lira. So let me adjust the size of the screen. Okay, so you click on that pair, And we are looking at a daily chart of the pair USD TRY, which is the Turkish lira. Let me zoom in. Okay, so let's say you want to buy the pair USD TRY. So you're gonna bet that the dollar will rise against the Turkish lira. So you just click here, buy, and then you'll see this window. That's the order window. So the first thing you want to decide is the units. How many units you want to buy? You're placing a market order. So we're gonna buy the pair at, and this is the quote. We're going to buy this pair at the price 1.7881. So you have to decide how many units you're going to buy, and that goes back to the previous slide when I mentioned the lot size. So let's assume that I have $10,000 in my account. So I'm going to trade one mini lot, and that's 10,000 units. Now the second thing you need to decide is your stop loss. So let's say I'm going to set my stop loss at 1.75. The stop loss is just an order, automatic order to close the trade if the price moves to 175. And we need to set our take profit, and let's do 1.90. And take profit is just an automatic order to close the trade if the price reaches that level. So we're going to open a trade buying at market at 1.7881 with a stop loss at 1.75. So if the pair moves down to 1.75, our stop loss will get triggered and we'll get out of the trade with a loss. And if it moves to 1.90, our take profit will get triggered and we'll close the trade with a gain. Now once you set your stop loss and your profit target, you can now see how much you're actually risking on this trade and how much money you can make if you are right. So here you see how much one pip is worth in dollars. The value of the pip will depend on the currency pair that you're trading and how many units you're buying. In this case, one pip is worth 56 cents. And here you see the trade value, because you're buying 10,000 units, that's the trade value. But this doesn't mean that you're actually trading $10,000 in this trade, because all the margin, because the broker will require a certain margin on this trade, and the margin depends on the currency pair and depends on the broker. For this particular broker and currency pair, you can see here that the margin required is 5%. So that's all you need to invest, 5% from your trading account. So because you're trading 10,000 units, and that's the trade value, $10,000, the broker will only require you to deposit 5% of that. So the margin used is $500. And here you can see your take profit. If the pair moves to 1.90, you'll make 1,119 pips on this trade. And converting that to dollars, that means you'll make $625 in this trade. But if it moves to the stop loss and you take a loss, you're going to lose $213 in this trade. So you're basically risking about 2% of your trading account on this trade if you have $10,000 in your account. So this is an acceptable risk. Now let's say you only have $1,000 in your trading account and you trade 10,000 units. If you have $1,000 in your account, you will actually be risking more than 20% of your account in this single trade. So that's too much risk. You should never risk more than 5% of your trading account in any single trade. And that's why it's important to pick the right size of units. So if you have more than $10,000 in your account, you could trade many lots, which is 10,000 units. But if you don't have that much in your trading account, you should be trading micro lots, which is 1,000 units. So that's basically how you open a trade. You determine the order that you want to buy. If you want to use market order, you're gonna buy at market. Then you have the how many units you want to buy. Then you determine your take profit and your stop loss. Then you can see how much money you are actually risking and what's the potential profit on the trade. And the same thing applies if you wanted to sell the pair. And if you wanted to sell the pair, you will be able to see how much money and how much money you can make and how much money you have at risk. So as you can see, it's very simple to open a trade. So let's go back here to buy, and I'm going to change this back again to 1.90, just so you can see what happens after you submit the trade. Stop loss 1.75. So after you submit the trade and you are comfortable with the risk that you are taking, you can open the trade and you can see that the order was executed at 1.7880. That was the quote at the time that you clicked submit. So now you have an open trade, and here's the stop loss at 1.75, and you see here the take profit at 1.90. So as you can see, it's very easy to open a Forex trade, and I hope this helps you if you are new to the Forex market. Thanks for watching.